right, guys. Well, I'm going to go ahead and start this presentation. This is our final presentation of the day, and I see a lot of you guys have been here all morning, so we really do appreciate that. Of course, you're in the Forex trading room, sponsored by Forex.com, so we always talk about Forex trading, that is our bread and butter, but we realize that not everyone trades Forex, and that's why I wanted to deliver this presentation as sort of a capstone to this mini masterclass, going from Forex 101, first thing in the morning, that Joe presented, to risk management, which he recently covered. We've talked about a number of other topics, but I think what's extremely relevant, regardless of what market you're trading or where you are in your trading journey, is trading psychology. And the way I've learned a lot, and I think regardless of what trading strategy you're using, you will not be successful unless you have a grasp of trading psychology. And that's why I've titled this presentation, Why You Are Your Own Worst Enemy When It Comes to Trading, 7 mental biases that are keeping you from reaching your trading potential. And I can speak from experience because I've made mistakes in all of these categories, and I hope that I'll see many of you guys nodding along as you think back to your own trading journey. Again, risk disclaimer here. I do have to display this for a brief period of time. Trading is risky. Always use proper risk management. Like Joe talked about, leverage markets can be particularly risky, and that's why we advise having stop losses, only using a small percentage of your capital on each trade. And that's really the gist of this risk disclaimer. All right, so what are we going to talk about in this presentation? We're going to discuss 7 cognitive biases hurting your trading results. We'll start with definitions, then we'll pull in an example from the quote-unquote real world, unrelated to trading. Then we'll talk about trading examples, and probably the most important part that you'll want to tune into is the mitigation strategies. Basically, how do you lower or limit the impact of these biases that we all have, including myself and you and you and you? How do we limit that impact on our trading and hopefully become more profitable traders? So there'll be a cadence to this presentation where we'll start with the definition, get a real world example, trading example, mitigation strategy. And of course, a summary and review at the end. Let's start with the definition. What are cognitive biases? They are systematic, subconscious errors in thinking that impact decisions. Now that, I might have even pulled that from a dictionary, but it doesn't really tell you what it is. Another term that you might have heard is a heuristic. They're heuristics, which are rules or methods that help solve problems more quickly and efficiently, or basically rules of thumb is the one I like to think of. Now, this sounds good, right? Solving problems more quickly and efficiently is something that we all want to do. But the thing that you have to realize is that our species, human beings, evolved on the plains in a completely different environment than we presently are, and our biology has not kept pace with the expanding, accelerating growth of technology. Our brains just do not evolve that fast, and now we have 1-minute charts, and we're getting updates from all over the world, and there's a conflict there between how we've evolved to be optimal decision makers and trading. And I think that is at the core of all 7 of these biases, and we'll kind of see some specific examples of that as we go on. And this is kind of the negative aspect. They can help you solve problems more quickly and efficiently, but they can also stem from social pressure. Out in the savannah, we need to fit in with our tribe, and if we did things that were contrarian, we risk being ostracized and dying. So we've evolved to conform to social pressure. We have selfish motivations and other evolutionary devices, and that conflict is what will be the undercurrent throughout today's presentation. All right. So let's start. Availability heuristic. That is a generic, uninteresting name. What is it? Well, it's kind of intuitive. It's the idea that uncommon outcomes are more likely to be remembered. So therefore, their future probability is overestimated. And it also is related to the fact that strong emotions tied to those rare events can bias perceptions and trading decisions. So that's our definition slide. It's kind of hard to put into real terms without specific examples. So let's pull in a real world example. And this is great because I can bribe you guys. We got these gift cards here. So I probably shouldn't have said that beforehand so we could actually get some natural participation. But what do you guys think are the most deadly animals to humans? That is the correct answer, as a matter of fact. Yeah, you don't mind coming up here. But that might not be the one that people commonly think of. I think you might have heard that question before, but yeah, enjoy a frappe on me. So yeah, let's pull up this graphic here. This is from Statista, but it shows the world's deadliest animals, and of course, mosquitoes is number one. But that's not really what you think about, and certainly if you're my wife, she loves watching the local news. If you watch that, you'd think crocodiles are killing people all over the place, or a pit bull attack, or the kinds of things you hear about because they're so fantastic. But really, what's most dangerous is mosquitoes, followed by humans. You do hear a bit about humans. And then snakes. I hate snakes, so I'm glad they made an appearance here. But again, shark attacks, I think, shark attack. Sharks kill roughly 10 people each year, but based on the news coverage, you'd think it's far more common than that. So in the real world, you might be, like my wife occasionally is, afraid to swim in the ocean because you think you're getting attacked by a shark, but then not even give any thought to putting on mosquito spray. And thankfully, we live in a first world country where deaths from yellow fever and dengue are less common. But the point stands here is that based on what's more sensationalistic, based on what's more what's less common, and therefore garners our attention, it can change how we analyze and make us be more subjective in how we're analyzing different situations. Let's bring this to trading. This is we're not really outlining any specific trading strategies here, but just at a high level, this is a variation of a trading strategy I've looked at before. So this is a daily chart here of euro dollar. I've plotted Bollinger Bands, which are a measure of volatility and mean reversion, essentially. And the idea is if we move above this upper Bollinger Band, that the market might be overbought and maybe more prone to revert back to the middle of the range or even the bottom. So in this example on the euro dollar, you might have identified that the market got into overbought territory, put in a reversal candlestick, something my colleague Joe talked about in one of his earlier presentations that's called a bearish pin or inverted hammer candle, and then dropped off. So you could look at those factors and say, maybe this is a reasonable spot to sell. And then, of course, practicing good risk management, we would want to place a stop loss on the trade. Logically, we could place it above the high of that candle. And you also like to have a target so you know your risk to reward ratio. Maybe you look to place your target here. Again, the specific trading strategy isn't as relevant, but I think regardless of your trading strategy, you might see this next part it is relevant to your experience. Haven't we all had this happen where the market doesn't really do what we were expecting, moves up, tags our stop loss, and then actually drops off a little bit? Now that's very frustrating. You say, well, maybe if I just move my stop loss a little bit higher, I would have still been in this trade. Or if I had not used a stop loss, I'd still be in this trade. And of course, inevitably, it goes on to do what we thought it would in the first place, hits our target, but of course, we're already stopped out of the trade. This is a rare occurrence, but it's certainly something that's going to stick in your head, isn't it? Where you just get stopped out of a trade when your analysis was ultimately proven right. And this could cause you to make irrational decisions moving forward. You might say, I don't like trading with Forex.com because the dealing desk is trying to gun my stops and take me out of a trade before letting the market do what it's supposed to do anyway. Or I hate the euro dollar, or I hate Mario Draghi, or I guess we're on Christine Lagarde now. But you start looking for people to blame, and you might make, again, irrational decisions and change a trading strategy just based on this one prominent, very frustrating, but just one example relative to a full set of a trading track record that you should have when you're looking at entering new trades. So how do we mitigate this? How do we limit the ability of our emotions to rule us on these types of trades? I always like to say it's important to develop and understand your own personal trading strategy. It's something that matches your personality. I think a lot of us here would gladly sign on to just copy trades from someone or adopt a profitable strategy. But the truth is, if it doesn't resonate with you, you're going to question it the first time it goes through a drawdown. And all trading strategies go through drawdowns. So by having your own strategy, that can help mitigate it. Don't stray from that strategy. Technical versus fundamental, different components we've talked about. This one, I think, is the key one here. Keeping a trade diary or track record of past trades. If you do that, and this is how I started in the industry. I was a junior technical analyst at a company called GFT, or Global Forex Trading. So our senior analyst at that time was giving trade recommendations to clients and didn't really have a track record of them. So I would go back, look at that trade recommendation, get a screenshot. What did it look like beforehand? get a screenshot afterwards. What did it look like afterwards? And by having just hundreds of trades and looking through those, you'll see past examples where your stop just gets hit. But you also will have a longer term track record to recognize, yeah, that does happen, but the trading strategy can still be profitable regardless. And it really helps put those particularly frustrating trades that are inevitable, regardless how you're trading, into more context. Yeah, and there you go. You're looking for outlier trades in both directions. This is tangentially related, but it's one of my favorite setups. I always like to say if a stock or a currency or a bond or a commodity doesn't fall on quote unquote bad news, maybe that's a sign that it's likely to rise from there. And it could be frustrating people on the other side of the trade from an availability heuristic perspective, in that they're saying, well, it's not doing what I thought, this is really sticking in my mind. That's when you can see those violent reversals. So that's a trade that also is relevant to some of these other ones, and I'm happy to talk more about that a little bit later on. Okay, so that's our first one. Number two, recency bias. You might have heard of this one. It's essentially the tendency to believe new information is more valuable and more important than older information. Guess what? This could actually be true. Sometimes there is a regime shift, and something that wasn't true in the past is now true. The example I use related to investing is that I think from the dawn of modern US markets until about the 1960s, stock dividend yields were always higher than the yield on a 10-year treasury bond. So anytime it started to get close, you'd look to buy the stocks and they would bounce back, or I guess you'd look to buy the bonds because they were the better value relative to your stocks, and it would be a profitable trade. That changed. So recency bias can be very useful in identifying regime changes, but since then, since the 60s, we have not seen the dividend yield on the S&P 500 get above equivalent treasury yields. So what's the risk in recency bias? It can cloud judgment and lead to excessive risk taking. And you might miss the forest for the trees, again, if you're focusing on just a couple recent examples. I love this one. This is crazy, and I'm not calling any of us pigeons, but I think there are some similarities. So Skinner, a famous psychological researcher back in 1948, set up an experiment, and he put some pigeons in a cage. Some of you might be familiar with this, and he had them peck a button that would give them food. Now, of course, if you realize, hey, I hit this button, it gives me food, this is a good thing. They started to do that, and then he had a different group of pigeons that had a button that intermittently gave them food. So every 3 pecks. Okay, well, that's reasonable. They can figure that out. Then, of course, and we're in a casino right now, so there's some parallels here. There was one that intermittently, at random intervals, gave out food. So, of course, these pigeons essentially became degenerate gamblers, but what's relevant from the recency bias perspective is that they started to believe that random actions that they made, because they recently worked to deliver food, would work in the future. And I love this, the way this is phrased. So one bird was conditioned to turn counterclockwise around the cage, making 2 or 3 turns before pecking the button again. Another was thrusting his head in one of the corners there. A third was doing a tossing response. 2 birds developed a pendulum motion with their head and body, and they're doing all these random things. Maybe we have lucky underwear that we use when we're entering certain trades or something like that. But they're drawing too strong of a conclusion based on what's happened recently and thinking that that's what's likely to happen moving forward. The investment implications write themselves. This is what's called a performance quilt. It just shows different asset classes and how they performed each year. So you get 2008, 9, et cetera, up through 2018. And bonds here in white were a strong performer, followed by cash in blue in 2008. Many of you may remember we were heading into the great financial crisis, very risk-averse environment. Traders are buying very safe assets like bonds and cash, and things like international stocks and emerging markets were at the bottom. Everyone, you couldn't find anyone to buy that. Everyone was aggressively selling it. Guess what? Market bottomed in 2009, and emerging markets went from worst to first. Bonds and cash went from first to worst. And you can see a similar type of randomness throughout here. And I think it underscores the fact that on a long-term perspective, it supports a diversified portfolio. But I think the more important part is that professional managers fall victim to this. And whether it's overall asset classes, whether it's a given stock or a given currency, they just want to buy what worked in the past. And a lot of times, that's a recipe for massive massive underperformance. If you sold your emerging markets here, you missed this huge bounce back, especially if you rebalanced into bonds and cash, and then they were the worst performing asset. And this is something that we all struggle with to this day. How can we mitigate that? Well, and this kind of relates to one of the previous ones, but you need to have a written trading plan. You might say, hey, I hold between this and this of this long-term investment. Or I say, I'm looking for a move outside the Bollinger Band, and I set my stop 10 pips above the high, et cetera, et cetera. And that way, if it's written out, then you can identify if you're moving from that plan for whatever reason, and realize that, okay, well, maybe this isn't the right decision for me to be making. This one will pop up a lot. This is probably my number one piece of advice for you guys. Keep a trade track record or a log of past trades, and that way you'll be able to, again, just take that longer term perspective and identify those longer term trends that are more relevant for the future. After a recent run of losing trades, we've all experienced this, you might not be in an optimal state of mind. So in that case, you might want to take a break or reduce your position sizing. I think that's the opposite of what most people do. If you've won a bunch of trades, you're like, oh, trading, I've got it figured out. I just got to follow my strategy here. It's an easy game. I'll be buying an island and drinking Mai Tais here next month. And conversely, if you have a run of losing trades, you're like, oh, I got to get back to break even. So I'm going to just put a little bit more on this trade. And if it wins, I'm good. Honestly, I think that the better thing to do would be reduce your position sizes so that you can remove that emotional component. The markets have been here for hundreds of years, and they will continue to be here for the future. Your trading capital might be more fleeting, though, so we always want to protect that. And if you're not in an objective, rational state of mind, then it can make sense to reduce your position sizing until you're thinking more clearly. You can research market history. I think we've talked about a number of examples here, but I always like this quote here from Sir John Templeton, a famous investor. He says, "The four most dangerous words in investing are 'this time is different.'" And sometimes it is different, but most of the time it's not. So always keep that in the back of your mind. Third fallacy to talk about is the gambler's fallacy. How apropos to talk about this from a casino. The gambler's fallacy, for those of you who are unfamiliar, it's the belief that unexpected behaviors or outcomes will be evened out by opposite behaviors or outcomes later on. And it kind of relates to two topics here. You might have heard of the mathematical law of large numbers. That says that as you get more iterations of a random process, it will start to move toward the long-term mean. But that doesn't necessarily mean you're due to win. What happens with the mathematical law of large numbers, and the next example here is related to roulette. This casino is 100 feet that way, is specifically engineered to take advantage of our gambler's fallacy. If you look at the roulette wheel, it'll display the last 20 rolls of the dice. And if you're like me, you see 10 reds in a row, and you're like, well, clearly the next one's got to be black. It's 50-50 mathematical law of large numbers. But what actually makes it 50-50 is just having a much bigger sample of 50-50. Not that because we've had 10 reds, we're more likely to get a black, but rather because we've had 10 reds, whatever. But over the next 10,000 rolls, we're likely to have about 5,000 blacks and 5,000 reds. And that leads quickly, the relevance of this, it can cause you to believe you have more information than you actually do, can lead to overconfidence, can lead to improperly changing your position sizes, as we talked about earlier. So here's the most prominent example I've found. Again, roulette. I'm sure we're all familiar with that now. This took place in Monte Carlo in the early 20th century, I think. What happened was there was a streak of roulette colors. I forgot whether it was red or black, but it went to 10. Of course, as I mentioned, if you guys are like me, you're like, it's probably got to go back to the other color now. Sure enough, didn't. Got 5 more blacks. So then it was at 15 blacks in a row. Well, by then, everyone at the casino's coming over and slamming their money on red. Guess what? Didn't happen the next roll or the next roll or the next roll or the next roll. I think the ultimate streak was something like 23 consecutive times it landed on black, which is very improbable from the start. But once you've had 22, it's about a 50-50 shot that it's going to land on black again. And what ultimately happened was all those gamblers lost their money, and it was the most profitable day for that casino in its history. So that's an example of people thinking they had more information than they actually did and making incorrect decisions because of it. Okay, how is this relevant to trading? It kind of writes itself, doesn't it? You can increase position sizes in a losing streak. My colleague Joe talked about the percentage of your equity that you'd risk on each trade. If you're in a losing streak, your overall capital is declining, something we've all experienced. If you're using a set, 2% of your overall capital for trades, then the raw amount you're risking on each trade should be ratcheting down in sync. So it's essentially increasing your risk as it becomes more risky, which is not what you want to do. And the example I wanted to use here, if you've ever seen a trading strategy, not to knock anyone here, but I wouldn't be surprised if someone's pitching something with this. This is an equity curve of what's called a martingale strategy, where essentially you double down or don't take losing trades. Look at this, and I probably should have blocked this end off here, but you can see very steady, a couple drawdowns here and there, but this is exactly what we all wish our trading account was doing, just moving steady up and to the right. But at the end, it gets blown out. What happened there? Well, it's your string of 20 blacks in a row. It's something that usually doesn't happen, but is catastrophic when it does, and that's why it's important to use proper risk management like we talked about and avoid what are called these martingale strategies. Okay, so what are some mitigation strategies for this? Well, you want to develop a written trading plan and stick to it, including, as Joe mentioned, risk management and position sizing rules. Here's our favorite friend, a recurring friend, keeping a trade track record. And what I really like is you can either back test it if you have a very objective strategy and say, okay, well, when the Bollinger Bands are doing this and we have this type of candle, this is what's happened historically, and you can go back a long ways. Or at a minimum, if that's not really your bread and butter, at least by keeping that trading track record, maybe trading with a demo account at first, you can say, okay, well, I traded this without real money for 3 months, and I did have streaks of losing streaks, but over the long run, it's still a successful strategy. So by having that trading track record, it keeps you grounded in a number of different ways and addresses, frankly, most of the fallacies we'll be talking about in today's presentation. Another one here is confirmation bias, somewhat controversial, at least in the way I'll phrase it on the next slide here. But confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms your pre-existing beliefs. We all do this. Every single one of us does this in a variety of fields. And honestly, I think it's people who can't admit this lead to a lot of the societal ills we have in the world. So this is something people have been doing for a long time. This is a quote from Demosthenes in 350 BC. So what is that, 2,400 years ago. What a man wishes, he will also believe. So we've almost already made up our mind by the time we start looking for information. We all think that what we're doing is the scientific method, right? We make a hypothesis, we gather and interpret data, and draw a conclusion based on that hypothesis. Realistically, what most of us are doing is making a hypothesis, saying, oh yeah, that's definitely what is happening here, and then gather and quote unquote interpret data that already supports your hypothesis. Oh man, this is the third rail of polite company, so hopefully you guys tolerate me talking about politics at a trader's event. But I like this, and hopefully we can keep this relatively objective, but you can see this essentially measures the median opinion from Pew Research on a variety of topics. Of course, Democrats in blue, Republicans in red. Back in 1994, they had different perspectives, but they were somewhat close on a variety of issues. As we got to 2004, somewhat close, both parties agree on some things, but not everything. Now what's happened? 2017, miles apart. The two political sides cannot agree essentially that the sky is blue. And my hypothesis, maybe I haven't gathered data to interpret it, so maybe this is me drawing a conclusion prematurely, but I think it's very reasonable to posit that this might be due to the rise of the internet. Certainly you can seek out communities with people who already believe and confirm what you do. It's a more comfortable way to go about your existence rather than exposing yourself to the risk that you might be wrong. Even if you do it subconsciously. Of course, cable news channels have also become more diverse in their opinions. And this confirmation bias factor, I think, is something that's led to our rather frustrating current political situation. How is this relevant to trading? I'm just going to include a quote here. You guys can draw a lot of conclusions, but I thought this was a funny quote and very self-aware, something that is very important for all traders. This is a quote from Michael Batnick, who blogs at The Irrelevant Investor. He says, "Years ago, I had fun trading weekly options around earnings releases. Very risky, volatile strategy. I would generally recommend against it, and I think he would too at this point. But he says, during one of these wagers, I meant to buy calls, so that'd be a bullish bet, thinking the stock would go up. But by accident, I bought puts. Well, that's the exact opposite. You're betting the stock is going to go down. In that moment, a funny thing happened. It wouldn't have been much trouble to unwind this trade. You just sell your puts, buy your calls. But instead, I rationalized why puts were the right decision. This is ridiculous. He literally misclicked and then said, oh, well, I'm in this trade. Actually, maybe it'll work out. He already had drawn his conclusion based on his position, and then he said, I guess I'm bearish now. And frankly, based on, and he'll say this himself, his previous examples, he wasn't any more likely to be correct on a bullish or a bearish bet. It was kind of random at that point anyway. But I just think this really captures in a very self-aware way that many of us can't do how pernicious and how negative the impact of confirmation bias is on our trading. Okay, let's mitigate it, guys. First idea, become aware of it. Great work. We've all done it. If you've zoned out and just saw this, couple of slides, you're already on the path to becoming a better trader because you're like, oh yeah, there's that confirmation bias thing that might be impacting my trading. And even this quote here from Scientific American says, skepticism is the antidote for confirmation bias. So be aware this is happening. Maybe intentionally seek out evidence to disprove your trade thesis. If you're long euro dollar based on bearishness about the US dollar, maybe you think Trump's going to get impeached and that's going to be bearish for the US dollar, and you're bullish on the Eurozone economy turning around, try to read some people, some intelligent, respected analysts that think the opposite and see, does that actually make sense? Do they have a point? And is that something that I should integrate into my view on the market? I try to ask myself this every time I place a trade, but what is the person on the other side of this trade thinking? What is the consensus wisdom, and why is that wrong if you're trading against it? And that question in the back of your mind can be very useful. The other one, unlike what Michael did there, is never change your reason for holding a trade. This presupposes that you have a reason for being in a trade in the first place. So that gets back to having a trading plan, something that's been proven over time, or if you're more of a fundamental trader, I think it's very beneficial to write it out. Say, okay, well, I think Euro's going to do this because of this, and the US dollar is going to do this. And that way you say, okay, you kind of cemented yourself to this reason, realize that it might be wrong, or that you might that it might change in time, but don't necessarily say, oh, that didn't work out, but now we got this jobs report coming up, maybe that'll bail me out. This is how traders get in a negative spiral and can lose a lot of their account on just one single trade. Okay, a couple more I wanted to touch on here. We're doing all right on time. Does anyone have any questions so far on things we've discussed? We've covered a lot of ground. I want to make sure you guys aren't confused about anything. All right, I'm either speaking very clearly or, I'm sorry? We do not have a booth at this event. That's a good question, but we will be here for the rest of this afternoon, so we're happy to talk after today's presentation. I think we have this room until 2. Yes, sir. Yeah, it's a good question. The question was how can being tired or maintaining willpower, I think, I forgot the exact term, it's something like willpower depletion. As you start to get tired, it just becomes easier to default to these ways that our minds have evolved to think. I think it exacerbates every single thing we're talking about here. So it's kind of beyond the scope of this presentation, but I think being in good physical shape helps your trading. Getting enough sleep helps your trading. Recognizing when you're upset because you just got in a fight with your spouse helps your trading if you can take a step back and be like, okay, I'm not in a rational state of mind. I'm too tired. I'm fired up about this fight. I'm drunk, which hopefully we're not doing. Things like that. It can be almost as severe as that, though, right? You'd say, well, I'm never going to do that, but the effect of fatigue or emotions can be even that extreme. So I think it's a really good point that underlies all of this as well and can exacerbate any single one of these. Okay, next one, loss aversion. Sounds like a good thing, right? We want to avoid losses. It's the tendency to prefer avoiding losses to acquiring equivalent gains. Very logical, but the problem is that it's a little too extreme in human beings. This is how we've evolved to think, very limited resources. We don't want to lose those resources. This is well proven throughout social science literature that the pain of a loss is more than 2 times the joy of a gain of the same magnitude. I put this quote here, it's better not to lose $50 than it is to find a new $50. I've kind of incepted you guys with the proper way to go about this. Can we get a volunteer? I'll bribe you. No? You guys? Sure. Okay, so answer this question. No, sorry, I'm not a magician. I'm not going to pull you up here. Would you rather get $200 guaranteed or have a 40% chance of winning $500 and a 60% chance of getting 0? I'm not actually going to give you the $200. I can't afford that. But just hypothetically, if a guy approaches you on the street and says, you can do this, well, you'd say, well, this is great. I think that is a rational decision, one a lot of people make. Second scenario, would you rather lose $200 guaranteed? You get a really weird pickpocket or hold-up artist that comes up to you and says, either give me $200 or I'll roll this 5-sided dice, and you could lose $500 if it's a 1 or a 2, so you have 40% chance, or I'll just let you go if it's a 3 or a 4 or a 5. Very weird scenario, but play along with me. Hey, again, sure, so lose the money guaranteed. That's the less common example here, and step up here, yeah. But what is more common, actually, is that people will pick A here, but they'll choose B in the second one because they don't, hey, thank you, I appreciate it, that they don't want to lose their money, right? They're walking down the street with $200 in their pocket. They certainly don't want to give that up, and they say, okay, well, probably a 60% chance I won't lose any money from this weird pickpocket, though I guess I could lose $500. So this, generally speaking, people select A and B, but what I wanted to emphasize is that in both examples, objectively, it's the same thing over the long term. The expected value of B in both cases is plus 200 and minus 200, but we're thinking differently based on whether we're quote unquote gaining or losing money. Hopefully that example made more sense than I thought it did there. Yes, sir. Yeah, it's a good question. I guess so the question was, does your level of wealth play into that? And I think it does. If the pickpocket comes up to you on the street and says, I'm definitely taking 2 pennies from you, and I might take 5 or leave you with all of them, you just be like, go away, man. We tried to set this here so it was a significant amount of money that would cause you to think about it, but it can play into it. And I think this is really the idea behind the insurance industry. Insurance companies make money. So most cities you're in, not Vegas, most cities though, there's some of the biggest buildings in the downtown are built by insurance companies, and they make that money by essentially taking advantage of loss aversion. People, in many cases, can't afford to, but even some that can, can't risk their house burning down because they'll be out, hundreds of thousands of dollars. So they pay money more than they should, in theory, in an equal world, to defray that risk and pass it on to the insurance company. And really, for most people, that is a rational decision, but it's the exact opposite of that, tossing the pickpocket 2 pennies. Your decision can change based on the level of wealth, but we kind of assume if you're trading, it's an amount that's significant to you. You guys all made the effort to come here on a what is it, Thursday morning. So you're clearly passionate about trading and you want to be able to make a significant difference on your life through trading. So I think this example kind of strikes that balance. This one, I'm not even going to talk about here. I'm just going to let other people talk for me. Loss aversion, how do we address this? What have other traders had to say about this? Ed Sakota, who's one of my favorite traders, says, cut your losses, cut your losses, cut your losses, then maybe you have a chance. You're going into the trade, as Joe talked about in his presentation, recognizing that you could lose. Some traders even lose the majority of their trades but are still profitable because they always cut their losses quickly and therefore are able to profit to a greater extent on their winning trades. Another quote from Ed here, if you can't take a small loss, sooner or later you'll take the mother of all losses and have your entire account blown out. So a couple of relevant quotes here as well from Jesse, I screwed up the order here, but I'll just slam all these on here and highlight my favorite one. This one here in the corner from Jesse Livermore. The only thing to do when a person is wrong is to be right by ceasing to be wrong. Cut your losses quickly without hesitation. That ego is an underlying concept throughout this, that you don't want to be proven wrong. You've done your research, you have an opinion on a different market event, and you think it's likely to work out in that way, but you have to always have strong opinions, but weakly held, ready to revise them as things change or as the market disagrees with you. And these famous, very successful traders all have the same idea at heart. Mitigation strategies, you're going to see a couple of recurrent ones here. A big one, I think, is not differentiating between realized and unrealized profits. A lot of traders will say, I got a $10,000 account, but I have a $2,000 unrealized trade, but it's not a real loss yet. In that case, it really is. You're just denying reality. You have to go into each trade recognizing it could lose, and maybe it makes sense to hold on to that trade, but you don't want to, again, change your thesis once you get into a trade. Many traders would rather be right on a single trade than make money over the long term. And I think this quote from Adam Grimes is very supportive of the whole idea of addressing loss aversion. You can lose your opinion or you can lose your money. And I think we all have to have that humble mindset and realize, yeah, we're going to be wrong occasionally, but over the long run, we can develop a strategy, hopefully, that can make us profits. The way I go about this, and I think Joe talked about the same, is setting a hard stop, small amount of capital risk in advance of entering each trade. And that way you say, you're recognizing, it's almost like a trick to tell yourself, hey, this trade could lose. So if it does, that's fine. I've come to terms with that, but I realize there's also the potential for profit. All right, so I have two more to talk about here, and I think I'm going to try to breeze through these a little more quickly. Tendency to rely too heavily on an initial piece of information offered when making decisions. That is what anchoring bias is. Anchoring bias has a very negative impact on our trading as well. What I think is cool here is this works even if the anchor is clearly irrelevant. The clearest examples were conducted, as many studies are, by college professors in college classes. And what one professor who was testing this out did was he just had students write down the last 4 digits of their social security number. So I'll use my wife as an example here. Don't steal her identity, but her last 4 are 9374. That's a high number, right? Some people might be 0026 or something like that. That would be a low number. Obviously irrelevant to just about everything, but subsequently the professor would say, okay, I have this coffee mug. How much would you pay me for this coffee mug? And literally people with high Social Security last 4 digits would pay more just because they were exposed to a bigger number beforehand, even though that should be completely irrelevant to how much you value a coffee mug. A similar example, maybe even more prominent, the professor just literally put a wheel here, Wheel of Fortune style, spun it, and if it landed on a bigger number, people were more likely to spend more money with it. I think there's some relevance here for those of you in negotiations, but that's probably beyond the scope of today's presentation. So we know this can impact us with even irrelevant numbers, and with trading there are some numbers that you could kind of convince yourself are relevant. Relevant? Relevant. I'm going to skip through this example here to get to the trading relevance example. So the most common anchor is your purchase price or your basis. Everyone says, hey, I'm up on this trade, at least I made money. Yeah, that was a frustrating trade, I lost. You don't necessarily want to focus as much on the purchase price or basis, because guess what? The market doesn't care what your basis is. It doesn't matter if you bought euro dollar at 113.12. What matters is, in my case, I'm a heavily technical trader, so the relevant support and resistance levels are what the indicators are saying. If you're a fundamental trader, what might matter is more how your thesis is playing out or what's happening with monetary policy. But the purchase price itself may not be relevant, so don't be making decisions necessarily if you're above or below that. Make it based on how likely the trade is to play out in the way you expected. Other anchors include historic highs or lows. You always hear people talking about Amazon checks all these boxes, massive PE ratio because they don't make a lot of earnings. And that might cause some traders just not to trade Amazon in any way because they think it's overvalued. Or the converse is also true. Certain stocks tend to have a very low price to earnings ratio, but might be a value trap where someone says, hey, it's so cheap. But there might be a reason it's so cheap. So you don't want to just look at one factor in any case. And I think that's the underlying current throughout this entire discussion of anchoring bias. So how do we address this? Become aware of your irrational anchors. Remember, a stock doesn't know where you bought it. And I like this idea here. This is, we're here for trading, so this is somewhat relevant, but certainly relevant for longer term investing. It's the idea of a zero budget portfolio. And this is a comment from Meb Faber, who's an investor that I'm a fan of. He says, if you wouldn't, so what you want to do is look at your portfolio. I don't know if you guys have, maybe you've changed jobs a couple times, you have an old 401k, your old neighbor 2 houses ago was really into Chrysler stocks, so you bought some Chrysler because you didn't want to see him get rich and buy a Maserati without you, and that was 20 years ago now, and you don't really follow Chrysler, but you still have it. The idea is with this zero budget portfolio is that you want to take a step back and say, what the hell am I holding all these things for? If I were to just sell everything right now, again, tax considerations you might want to look at, but assuming those don't matter, would I actually buy this Chrysler stock? Would I hold the things that I have in my old 401k? And in most cases, if we're being honest with ourselves, we probably wouldn't. There's an optimal portfolio for us, and we might have an idea what that is. Hopefully we have a trading plan that's outlined that. And if something's irrelevant to it, from a zero budget portfolio perspective, you might want to cut that out and realign with what you think is the proper allocation long term. Okay, last bias here, and I just got a 5-minute warning, so we'll breeze through this one, but I like this one a lot. Breeze. It's a pun you'll see on the next slide. The tendency to attribute one's successes to personal characteristics and one's failures to factors beyond your control. So it's related to two things, two related biases, confirmation bias and optimism bias. And it's something we've developed to protect our egos. I think we've all experienced this on the road. If you get cut off by a driver, you might be inclined to flick him off or be like, that guy's a douchebag. But I don't know about you guys. I'm not a perfect driver if I'm speaking rationally. I've probably cut people off before. I'd like to say I hadn't. But when that happens, you're like, oh yeah, well, I was messing with the radio. Like, obviously, sorry, man. But again, you're not treating those two scenarios as equivalent, recognizing that maybe that other guy made a mistake, or maybe you were driving recklessly. And the best recent example, I can still use this because the NFL season's still going on, though it relates to last year's NFL season, is related to the Saints, whose quarterback is Drew Brees. You guys may remember NFC Championship game. Saints in black here are driving. Drew Brees threw the ball here to, what was that, Brandon Cooks? I forgot the receiver. But anyway, obvious pass interference scenario where this bloke for the Rams tackled him before the ball got there. Refs missed the call, and the Saints went on to lose the game. So naturally, they were very upset. Saints got robbed, took out billboards, blamed the refs. But what I want to highlight here is a number of things happened. First of all, it was like a very close game at this point in the fourth quarter. Then the game ultimately went to overtime. So the Rams got the ball back. I think they drove down, kicked a field goal, lost the toss. The Rams did. The Saints won, failed on their drive, and the Rams went down and scored again. So it's very tempting from a self-serving perspective to blame the refs, and certainly they made a mistake. But we're not thinking rationally in that case because the Saints still had at least 3 chances to win the game, either by stopping the Rams, taking their drive, or stopping the Rams again. So this kind of relates to trading very directly, in which case I think this 2x2 matrix is something that we all have experienced at times. When you have a winning trade and you have broadly correct analysis on the market, this is great. This is what we're all striving for. We want to be in this. We're correctly in tune with the market. It works out as we're expecting. Sometimes, though, there's an element of randomness. You could have a winning trade, but incorrect analysis. Maybe you thought a certain report would work out a certain way and it didn't, but your trade won anyway because there was a surprise Trump tweet or something. In that case, you're like, good, yeah, that's all right. I'm a good trader. Sometimes you get lucky, but you're not seriously evaluating what you got wrong on that trade. And of course, the converse is also true. When you have a losing trade for incorrect analysis, you can get frustrated or discouraged. You might consider completely remodeling your trading strategy. Or if you have broadly correct analysis, but still have a losing trade, maybe that Trump tweet goes the other way and knocks your trade out, that's when you start to blame those external factors. And again, in both cases, you're getting discouraged and frustrated. It's hard to do, but honestly, we really want to be evaluating ourselves more on these rows. Were we mostly correct or mostly incorrect in our analysis? Not necessarily in the short term, whether that specific trade won or lost. So a lot of examples related to recency bias there as well. A couple quick highlights there as far as mitigation strategies. Look for opportunities to improve after every trade. Regular trade reviews are an important process there. I always like to share my trading experience with like-minded peers. They can kind of hold you accountable, right? If you say, I'm selling euro for this and it goes down, but it goes down because of a Trump tweet, well, hopefully you have some friends or a community that can say, well, you got lucky on that one. You probably shouldn't be patting yourself too hard on the back. So I have just one big review here. This is the most important slide in the presentation, so I want to make sure I get on this before my time is up. The main mitigation strategies, regardless of which cognitive bias you're struggling from, and we are all struggling from all of them to an extent, is to incorporate some of these ideas. Be aware. Great job, guys. You're doing it. We're already aware of them. We've already taken a step toward improving our trading and making it more objective. One that we saw recurrently was a written trading strategy, including risk management and being sure that we stick to it rather than varying based on the whims of our emotions. We want to keep a trade diary or track record so that we have that longer term perspective and context. And one that I think is underappreciated, underutilized, but identify when your emotions are running high and reduce your position sizes or taking a break. It's hard to do, but over the long run, it's something that'll be successful or help you improve your trading. And I think that's something that the longer we trade, the more we realize the market's moving, it's constantly changing. We'll have an opportunity come the next day as long as we protect our capital. Okay, I have a slide here for questions. Do we have any quick questions? I only have 1 or 2 minutes here. Yeah, I think you guys are all afraid to admit you're suffering from these, but I certainly have no shame. If you do want to come up to me and talk to me about this afterwards, I'm happy to. This is something I'm really passionate about and has really helped my trading. So I'm happy to discuss any questions you have or hear more about your experience with trading psychology. Yeah, one question in the back. Lots of books. So the cliche recommendation is a book called Thinking Fast and Slow by Daniel Kahneman. It's hard to read. You have to be motivated. It's like 600 or 800 pages. It has a bunch of those cool examples that I brought up, but I think there's more accessible ones. One that I just read this in the past week or two, and I thought it was a very good digestible distillation, is called The Behavioral Investor by Daniel Crosby. It was recently like $3 on Kindle if you guys do that. And that I really thought succinctly summarized a lot of these ideas and again talked about some of those mitigation strategies. So Behavioral Investor by Daniel Crosby would be my strongest recommendation off the top of my head. Did you want to come up, Joe? And we know most of you guys have been waiting here for this extended period just for the chance to win a backpack. All right, so the winning ticket is number 066049. Oh, this gentleman. Hey, cool. All right, we'll be here. We have this room, I think, until 2 if you guys want to ask questions or just hang out.